One of the biggest FAFSA misunderstandings is the difference between income and assets and how the FAFSA assesses both and the timing used for income and assets. Now, for the FAFSA, income is a significant part that measures your financial aid eligibility, but assets matter too. The key is to understand the how and the when FAFSA uses each. FAFSA primarily focuses on income, and FAFSA assesses income anywhere from 10 to 25% of your adjusted gross income. If your adjusted gross income is closer to $100,000, you'll be assessed around 10%. And if it's over $250,000, it'll be assessed around the 25%. Now, assets are also assessed, but they're assessed at a lower rate. Now, this is where families get tripped up because what they don't understand is the formula that FAFSA uses around your income. For income, FAFSA uses something called prior. And what that means is they're actually looking at your income 2 years prior to your student going to college. So if you have a student going to college in 2027, they've actually will be using the tax return from 2025. And you see that's why it's prior because it's 2 years before. You can see here by the time you fill out the FAFSA, which is October 1st of your student's senior year, your income is already set. There's no going backwards. Now, assets are assessed differently. Assets are done in real time. So when you go to fill out your FAFSA, you're going to use the value of your accounts basically on that day. So income is historical and fixed, whereas your assets are current and can be far more flexible. Now, the difference in this timing can create some opportunities for us, but you have to know the rules and understand how it works. Now, FAFSA is not a one and done. You are required to fill out the FAFSA every year that your student is in college. And remember, income reported is in that prior, so 2 years in the past, whereas assets are actually current. So you'll be using the current value of your assets every time you go to fill out the FAFSA while your student is in college. I hope you're beginning to see that college planning is not just 1 year. College planning, we have to plan for the entire college experience, and college planning really begins years before your student actually goes to college. So what assets does the FAFSA include in their formula to determine your aid eligibility? Well, it's things like savings accounts, checking accounts, any brokerage accounts, accounts that are not considered qualified plans or retirement accounts. What's also included are trusts, depending on the beneficiaries of those trusts. Mom and dad, if you own a small business, the value of your business is required to be put on the FAFSA. And if you have a rental property, or if you have an office building, any equity in real estate that is owned by the family business is also included in the assets for FAFSA. Now, lastly, farms. The net worth of farms are now included in assets for the FAFSA. Now, the good news, as we discussed, is assets are assessed at a much lower rate. So assets are looked at for 5.6%. That's how much they're assessed. Where remember, income is 10 to 25% of adjusted gross income. Now, there are some assets that are completely excluded from the FAFSA equation, and that's money already in a qualified plan like a 401k, an IRA, 403b, 457, a pension, cash value life insurance, as well as annuities. And on the FAFSA, they do not include equity in your primary residence as an asset to help pay for the cost of college. So understanding what's not required on the FAFSA can be equally as important as what is required on the FAFSA as far as assets are concerned. Now, let me be clear. This is not about shifting assets around at the last minute. Many families that do this actually hurt themselves even more. It's about understanding the rules early so your family can make the best decisions to support their student. My goal is always protect your retirement first, pay for college in the most efficient way, and be sure you don't sacrifice financial aid dollars that you could have earned because you did it wrong. College financial planning starts years before your student ever goes to college and continues the entire time that they're in college. So if you're interested in understanding your family's best plan to save and pay for college while still protecting your retirement, please don't hesitate to reach out. Thank you.